Traders is going to continue. Also a lot geopolitically, of course, high stakes. This meeting between North and South Korea taking place on Tuesday, discussing plans for the Winter Olympics, but also taking place as we see these jabs on Twitter continue between the US president towards the North Korean leader as well. In the meantime, we're looking ahead to the opening of earnings season. All signs looking pretty positive for this Asian bull market at least. Let's get over to Sophie for a look at how the China and Hong Kong opens are playing out. So,
well, Heidi, we have a bit of a mixed picture when it comes to mainland markets. You have the large cap gauge slightly higher, but small caps under pressure, and the Shanghai Composite that is stalling after a 6-day advance. But following a 9-day rally, the Hang Seng is adding about 0.2%, so a 10th day of gains there. And for the H-share gauge, it is rising 1/3% after the best week in 3 months for the index. Now, checking in on some Chinese auto stocks, this after some re-ratings, you have Geely and Guangzhou Auto. They were cut to equal weight on Morgan Stanley, while BAIC Motor was raised to overweight. Now, flipping the board to check on Chinese airline stocks as the government removed caps on ticket prices for domestic flights, thereby paving the way for higher prices for flights on the mainland. And when you take a look at the Shanghai Composite, we do have those.
Good morning, this is DayBreak on Bloomberg Quint Live, and I'm Alex Matthew. Let's first look at the headlines. Asian markets are off to a cautiously positive start to the new trading week as investors await the start of the quarterly earnings season. Japanese markets are shut today. US President Donald Trump says the US is open to engaging in discussions in the Korean Peninsula at an appropriate time. The government asks companies facing insolvency to not pay the minimum alternative tax, and that's a relief to the stressed companies. And former Governor of the Reserve Bank of India, Raghuram Rajan, advises steady removal of monetary accommodation rather than a sudden shock to the markets. Let's turn to the international markets now, and US stocks rose on Friday, capping off a strong start to the new year, as Wall Street shook off the jobs data that missed expectations. The Dow and Nasdaq enjoyed their best start to a year since 2006. Bloomberg's Abigail Doolittle wraps up all of the US market for you in this report.
The first week of trading in 2018 has been kind to U.S. stock investors. The Dow, S&P 500, and the Nasdaq finished higher each of the 4 days. That means big weekly gains for the major averages, each carving out new record highs. And the S&P 500 and the Nasdaq put up the best weekly gains since December of 2016. So a bullish start for trading action in 2018. Now, relative to the top point boost for the S&P 500, tech and the big internet names dominated. This includes Apple, Facebook, Amazon, and Microsoft, as investors seem to want last year's big rally in tech to extend into the new year, as it is, at least right now. Not surprisingly, Haven bonds were down on the week, as was the Japanese yen, investors going after the more growthy stocks. Interestingly, though, gold, also commonly considered to be a Haven asset, was higher as well. So a little bit of a divergence there among the various Haven assets. Probably helping gold, though, the dollar. The Bloomberg Dollar Index was down for a 4th week in a row, and this may have helped oil climb higher on the week as well. Truly higher in the week, though, Bitcoin up about 17% on the week. Its best week since right before the cryptocurrency's launch on SIBO back in December. Now, looking ahead to next week, investors will look to see whether or not this bullish momentum and the stock gains and record highs will continue ahead of the start of earnings season. In New York, Abigail Doolittle, Bloomberg News.
And it's earnings season that we're going to be talking about in Asia as well. Let's turn, in fact, to the Asian markets. The Japanese markets, like we told you a little earlier, are shut today. But to give you a sense of what to look for apart from that, we're joined live by Bloomberg's Rosalind Chin. Morning, Rosalind. What are we looking for today?
Well, certainly there's not a lot of data out to move the markets today. And as you say, Japan is closed. But there are other things which are keeping sentiment buoyant. So, of course, there was the record high on Wall Street last week, which is helping that sentiment. But also, we are looking at earnings, for example. The earnings season, which is just about to start around the world. Now, we're seeing, according to Bloomberg data, that profit estimates for all Asian stock sectors were increased over the last 3 months of 2017. So cyclical shares likely to see the steepest upgrades from analysts, about 5% on average versus an increase of 4.4% for the wider MSCI Asia Pacific Index. So that can help the stock markets here in Asia feel more buoyant and stay more buoyant as well. Sentiment generally quite positive. So MSCI Asia Pacific, Nikkei, it's closed as a topic. So we're going to look at the Kospi right now. That is gaining about 0.14%. The Hang Seng, which is just open for trade, up by about 0.25%. Shanghai Composite just about flat, but still poking a little bit into the positive territory there. And Straits Times, Taiwan TAIEX, and also Jakarta's composite index also making gains this morning. Now let's look at Australia. The S&P 200 extending gains from the highest level in 10 years. Now we see gold miners though there have been falling, and that is largely because of a government report saying that they see gold prices falling in the next 2 years, and that is due to pressure from US Treasuries, which are climbing. So we're seeing Evolution Mining down by 1.5%, Saracen down by 0.6%, and Mineral Resources down by 1.3% this hour. Those stocks there taking a bit of a hit. In the rest of the region, we see French President Emmanuel Macron in France, from France in China, and we're going to see probably a slew of trade deals done there. And we're going to keep an eye on what's happening with Chinese carriers, as there is a report that that ticket sales the prices on tickets will be lifted, the cap, by the Chinese government. So we're likely to see increases in prices on domestic flights in China. Back to you.
Thanks so much for wrapping that up for us, Rosalind. Let's turn to the Indian market now, and Darshan Mehta and Agam Vakil are here to set you up for the day's trade and to tell you what's happening in the futures and options space. Morning, guys. Darshan, first to you. Earnings this week, that's pretty much the headline that we're talking about. What else do you have for us today?
Yeah, so if you're looking at it, at this point of time, the SGX Nifty is indicating a big positive outlook, but commodities are seeing a big sell-off. So that's what you're seeing. Above the 10,600 mark in trade, that's what the SGX Nifty is pointing. We closed at record high, so there is a lot of traction. Among the ADRs, Dr. Reddy, Infosys, Tata Motors gained significantly in trade. What didn't do well was Wipro and HDFC Bank. They were down in trade. Overall, if you're looking at crude also, crude was down almost 1% on Friday, opens with gains in early trade. But if you're looking at the weekly close that was there, that was positive for crude. Week closing for commodities on Friday on the LME, except for zinc, all of them were down. So aluminium was down 2%, lead was down 2%, copper was down close to 1%. You had nickel and zinc which were down almost 1%. Nickel was down 1%, zinc was flat in trade, and tin was up 0.6%. Even if you're looking at what's happening in China, and the COMEX copper is trading higher by 0.2%. What is happening in China? Very weak opening by China. A couple of commodities like aluminum and copper have actually opened down almost 1%. Iron ore is trading down, rubber is trading down. So negative cues coming in for the commodity basket in China. Gold opens muted, closed almost 0.2% lower on Friday. So gold also not seeing enough traction that's coming in. As far as flows are concerned, FIs bought in 580 crores in the cash market on Friday. This is the provisional data. DI has bought in 243 crores in the cash market. So overall, if you're looking at the month-to-date data, FIs have bought in 1,000 crores in the cash market in the month of Jan, and DIs have sold it almost 937 crores in the cash market. Overall, if you're looking at the Nifty itself, very strong traction that came in. Nifty closed at record highs and gained for the fourth straight session. If you're looking at the broader markets, the mid caps, the small caps, they managed to outperform the Nifty significantly. IT was one of the biggest gainers. It moved up in trade significantly. PSU banks were rather weak in trade. Overall, if you're looking at the Nifty, Nifty was up almost 50 points. What contributed? It was banks basically and the NBFC. So HDFC, Yes Bank, and IndusInd Bank gained significantly. On the losing end, you had IT and a couple of, and some of the banks like SBI and ICICI. So, but overall, the traction seems to be on the higher end for the market at this point of time. But Agam, what are you sensing on the F&O side?
Well, we had mixed cues from the banks, Darshan, at least as far as Friday trade is concerned. But let me start off with the futures. And as you can see, we've been seeing some amount of longs building up as far as the Nifty futures go. Coming to the bank Nifty, that is where we've also seen a little bit of a change, up as much as 0.5% for the underlying, and longs building up with 8% increase in open interest. The VIX, of course, fell further, still above the mark of 13 at around 13.1, and the put-call ratio didn't see too much change. just about 1.58 right now as against 1.54. However, when it comes to changes in open interest with respect to levels, what we're looking at is a lot more activity around the mark of 10,500. So as you can see, more puts building up here, and this can be taken as a positive sign for those who are bullish in the market. That said, with respect to changes in the F&O, this is, I think, it's the incorrect one, yes, but we do have longs building up in United Breweries, near 44% addition towards open interest, and similarly, we have several other counters such as Equitas Holding, which is up 15% open interest, excuse me, and Just Dial, which has also seen near 10% increase in open interest. Of course, instead of 20 Micron, which showed up, that was Reliance Communications actually, which moved into the F&O band. So we'll expect restricted trade there. But these are some of the bunch of the stocks that we need to keep an eye on as we go into trade today, Alex.
Thanks so much for that, Agam. Let's move on now, and we're talking about the Indian economy. It's expected to grow at its slowest pace since 2014 due to weaker growth in the agricultural and manufacturing sectors. First advance estimates released by the CSO peg GDP growth for the current financial year at 6.5% compared with 7.1% in FY17. Growth in gross value added terms is pegged at 6.1% versus a revised 6.6% in FY17. Ida Dugal sums up the implications in this report.
At 6.5% GDP growth for fiscal 2018, the growth numbers released by the CSO, which by the way are the first advance estimates of GDP growth in the current fiscal, are more or less in line with expectations, although mildly disappointing. The Bloomberg consensus estimate had pegged growth at 6.7%, so at 6.5%, you get a sense that the economy is struggling along, and that's exactly what it's doing. It is struggling along. Various segments of the industry are doing so. Before I get to the sectoral breakup, the GVA growth numbers, which are tracked a little bit closely by policymakers, are suggesting that growth is at 6.1%. Actually, the bigger disappointment is on GVA growth because remember, the Reserve Bank of India at the December policy had said it expects GVA growth of 6.7%. So the bigger miss is on GVA growth, which takes out the impact of subsidies and also of indirect tax payments. Underlying economic trends is what is getting reflected in the GVA number, which continue to show some amount of weakness, perhaps on account of the twin shocks that we've gotten to the economy in the last 15 odd months, which is demonetization and then GST. Where are we seeing the pinch on the economy? Well, one thing is the farm sector. It's disappointing to see farm sector growth at just 2.1% in a year when you had a normal monsoon. The problem is that the monsoon was delayed in some parts, certain parts had floods. So agricultural output this year has been weak, even though the monsoon season overall was normal. So the farm sector has been a disappointment. Manufacturing at 4.6% growth versus 7.9% is also a weight. Now remember, in the second quarter you had seen some pickup in manufacturing. It's possible that when you get the final read on Q3 and Q4 you see stronger numbers on manufacturing, but so far based on the extrapolation of the numbers available, the CSO expects growth in manufacturing to be weak at 4.6%. Other segments I want to flag off: construction is slightly stronger than last year, as is the financing and real estate segment. The public administration part, which is linked to government spending, is predictably weak. They're expecting that to grow at 9.4% this year compared to 11.3%. That's a consequence of the fact that the government's finances have been strained. If you look at the expenditure side data, the trends that are coming out in the full year data are pretty much the trends that we've been talking about in the first quarter and the second quarter data. Gross fixed capital formation, which is an indicator of private investment in the economy, is seeing some pickup at 4.5% compared to 2.4% last year. Siddharth Sanyal of Barclays India, who was with us on an earlier show, said that let's not pop the champagne yet because this slight improvement is on a very low base. Private consumption has weakened a touch, but nothing dramatic. At 6.3%, private consumption is lower, or growth in private consumption is lower than the 8.7%. And then finally, government consumption, again linked to government finances, is weak at 8.5% compared to 20.8% last year. So that government part is really pinching the economy on top of everything else. that has been sluggish. Just a last point on nominal GDP growth. Nominal GDP growth is at 9.5% compared to double-digit 11% growth last year. Nominal GDP takes on importance because a lot of the tax revenue projections are built based on the nominal GDP number. So a weak nominal GDP number will put the government in a bit of a spot even when it's preparing next year's budget. And remember, next year's budget numbers are based on the first advance estimate. So overall, the take on the economy is it's improving, but it's not improving particularly rapidly, at least not based on these numbers.
Well, we'll have to see what the reaction in the bond and the rupee market is later today, and we'll get to that in just a moment. But before that, former Governor of the Reserve Bank of India, Raghuram Rajan, believes that the global economy is firing on all cylinders. He is, however, cautious about inflationary risks to monetary policy as well as risks to the financial sector. Speaking to Bloomberg TV's Michael McKee, Rajan says that the best thing to do right now is the steady removal of monetary accommodation rather than a sudden shock to the markets. Listen in.
Whenever there is asset price inflation, you have to ask why it is that way. And clearly there are some supports for it. Growth is strong for the first time across the world. You're seeing Europe come back very strongly in the last few quarters. Japan is going the normal way it goes, a country with a labor force declining at 1% a year. For it to grow at 1.5% is great. And the US is doing reasonably well. So with all the engines firing, on the real side, there is some optimism. The concerns have to do with two factors. One is the monetary side, and second, the financial side. On the monetary side, when do we see inflation? If in fact you have strong growth, you have economies at levels of unemployment which haven't been seen for a long, long time, when do we see more wage inflation? When do we see that translate more into goods inflation? That's the question on the monetary side. When that happens, you will find interest rates picking up more strongly, and of course that will have an effect on asset prices. The other factor is the financial side. How much debt have we built up in these years, in these go-go years, on the retail side, on the government side, on the corporate side? Covenant-light loans are at an all-time high at this point. So the question is, at that point, when interest rates start picking up, when liquidity seems a little less available than it is now, do we see a substantial reaction on the financial side?
Well, that's the question. When does this stop becoming just a talking point among academics on Twitter and become something that policymakers need to address?
Well, the question is, what do you do to address it? And I think the best thing that can be done at this point is a steady removal of monetary accommodation as the economies look strong. Let's not try pushing it to the last limit. I think as you remove monetary accommodation, you signal also that the financial side needs to adapt, and you give them time to adapt, which is important. So the buildup of leverage that you see, both the implicit leverage in positions as well as the explicit leverage in debt, I think that will start tapering off if in fact there is a signal that accommodation will be taken off. Now, you have to do it in a steady way because you could affect asset prices considerably if it comes as a shock.
But you don't think the argument that we can let rates stay where they are because we're not seeing any inflation is worthwhile?
Well, I think central banks obviously are forward-looking. They have to ask, is this going to stay the way it has been, going forward? And the one thing that is changing is earlier you had slack somewhere in the world. Today, with unemployment coming down across the world, the sense has to be that there's less slack. And as a result, the competitive pressures across the world, which kept wage growth down, may not show up as much going forward. So wage growth will possibly pick up. You already see inflation in some countries, Canada, for example, picking up more strongly. The second aspect of this is really central banks are also at the back of their mind thinking about financial sector risk. That it's not the front of mind is inflation, but if financial sector risk is also building up, we should not surprise the world suddenly with an inflation report which shows we are way behind the curve. So I think that would suggest, so long as there's this uncertainty, steady, slow removal of accommodation makes sense.
Right, let's take a check on the rupee and the bond market now. And Saloni Dhanuka is here with all those details. Saloni, morning.
Good morning, Alex. So the rupee on Friday continued its winning run for the second consecutive session, and it ended at a 32-month high of 63.37 levels against the dollar. Now, remember, the home currency has strengthened by a good 55 paise since the start of 2018. Meanwhile, India's foreign exchange reserves surged by $4.5 billion to touch a record high of $409 billion for the week ended December 29th. On the global front, the dollar declined for the fourth straight week to mark its longest losing streak since May 2017. Now, the dollar index dropped after data showed that the US economy added 148,000 jobs in December, which is well below the forecast of 190,000 jobs by the Economist. Well, coming back home, dollar rupee is trading at 63.28 levels against the dollar in the non-deliverable forward market, which indicates a stronger opening for Indian rupee in today's trade. Well, moving on to bond market, sovereign bonds on Friday gained after Economic Times reported that RBI is looking to pay additional dividend to the government, thereby reducing their borrowing for this fiscal year, and hence 10-year yields ended at its highest level in over a week at 7.29%, while global funds decreased their rupee debt holdings on Friday by close to 60 crores according to NSDL data, Alex.
Thanks, Saloni. Let's shift focus now to the commodity space, and Jayesh Khilnani has all the updates there. Jayesh, morning.
Morning, Alex. Let me start off with oil prices, which actually saw the best opening week for any year since 2013. So for the entire week, WTI rose as much as 1.7%. Now, this was on the back of US stockpiles, which actually rather output, which grew as much as 9.78 million barrels for last week. That said, the metals rally that has seemingly come to an end, with the metal index declining as much as 1% on Friday. As far as individual base metals are concerned, we had aluminium, which was the top loser, was down 2%, lead was down 1.8%, and on the other hand, we had copper and nickel, which also declined as much as 1%. Tin was the sole gainer, which actually gained about 0.6%. Moving on to the precious metal space, we saw that gold futures posted the best rally in about 4 decades amidst the dollar drifting down below the 92 mark. Now, gold was up 11 sessions in a row, which was the record rally that we saw since 1975.
Thanks, Jayesh, for that. Let's move on now. In a much-needed relief to companies facing insolvency, the government has relaxed the provision for the companies to pay minimum alternate tax. Payaswini Upadhyay has more details in this report.
In an important relief, the tax department announced that going forward, there will be no minimum alternate tax liability on companies facing insolvency proceedings. And here's why this is important. So far, what was happening was, let's say a company, a stressed company, had a debt of 100 rupees. And because of the loan write-off and the interest write-off, that debt came down to 50 rupees. The 50 rupees that the write-off was happening goes into the P&L of the company and is taken out, is looked at as the gains by the company, on which there is a 20% MAT levy. Well, the tax department has said now that effective FY 2017-18, this loss that is so far was being seen as the income of the company will not attract MAT. Why is this important? Because so far the bidders were pricing their bids taking into account this tax cost, and now what will happen is that these stressed companies are likely to get a better value for the assets, and also the lenders will get a better value from the incoming investor.
Now, it's been a stellar Q3 for Goa Carbon with a 160% jump in revenue numbers. Let's head across to Nikki Mirchandani, who's here to tell you why this company is the stock of the day. Nikki?
Hi Alex, good set of numbers coming in from the company yet again. If you look at the revenue, as you just mentioned, it's a 160% jump that we're looking at a number of around 187 crore as compared to 72 odd crore. Net profit for that matter, it stands at 22.23 crore as compared to a loss figure that we were staring at of less than a crore in the corresponding quarter of the previous year. It's been a good performance on the operational front too. If you look at the EBITDA, that's a good jump at 38.3 crore as compared to a number of 1.9 crore. That's like almost a multifold jump that we're looking at. Margins have expanded to 21% as compared to a number of 2.6 crore. Now, continued reduction in your raw material cost along with your employee benefits is what has led to operational efficiency for this company. If you look at the raw material cost, that as a percent to your net sales has come down to 70% from 79% in the corresponding quarter. Employee benefits as a percent to your net sales have reduced to 2.3 from 5.7%. And we have also seen a significant reduction coming in on the finance cost and higher other income, which has led to a sharp jump up in bottom line performance. That's your profitability performance along with your good operating performance. Other income has jumped over threefolds to 4.4 crore as compared to 1.26 crore. The company we're talking about is a manufacturer of calcined petroleum coke for that matter.
Thanks for that, Nikki. And let's head across to Shraddha Babla now for all the other stocks in the news. Shraddha, what do you have for us?
Hi Alex, morning. To start off with, JP Infratech will be in focus. This is on the back of a ET report which says that Tata Housing and Lodha Group are interested in buying JP's Yamuna Expressway. So we could see some positive reaction there. NBCC also we could see some positive reaction on the back of order wins to the tune of 2,000 crores. You also have Shobha, which will be in focus as the company's Q3 new sales value is the highest in the past 11 quarters at 751 crores. So the new sales volume stood at 9,33,000 square feet. Average realizations moved up marginally by about 2 or 3% on a sequential basis. Sagar Cements, where the December sales are up 65% on a year-on-year basis. Force Motors here, on a year-on-year basis, the numbers may look slightly weak, but on a month-on-month basis, the performance has improved. But December domestic sales stood at 1,900 units and exports stood at 21 units. Sun Pharma may also be in focus. This is after ET reported over the weekend that US FDA may inspect Sun Pharma's Halol site in February. So keep an eye out on that name. CMAC Limited says that they have entered into a charter party with GOPL Offshore for the charter hire of vessel CMAC 3 for about $2.4 million. So some positive reaction expected there. And lastly, we also had news coming from PTI which said that JSPL could raise up to 1,000 crores via QIP in February, and they could also raise up to another 2,000 crores by listing its Oman business. All of these stocks to watch out for.
Shraddha. Let's head straight across to Somit Sarkar, who has all the big brokerage calls of the day. Morning, Somit.
Good morning, Alex. On the big brokerages, first we have is Kotak Securities on Mahindra Logistics. Now they have initiated coverage on the stock with a buy rating and a target price of 520. Now Mahindra Logistics is well placed to leverage its unique asset-light business model and its large client base. Now Mahindra Logistics is the most asset-light third-party logistics service provider among the listed logistic company, and the shift towards a third-party logistic will drive growth for Mahindra Logistics going forward. Also, the brokerage is expecting the non-auto sector growth to accelerate to double-digit growth going forward. Also, the business of Mahindra has a scope to expand into other avenues like cold chain, cargo movement, etc. The brokerage is also expecting the timed resolution of the issue of tax deducted tax source exceeding payout based on corporate tax to normalize the working capital requirements for the company. Now, the brokerage is expecting the company's revenue, EBITDA and net profit to grow at a compounded annual growth rate of 24%, 31% and 30% over FY17 to FY20. Lastly, Mahindra Logistics, which is trading at a premium to peers, is justifiable given the growth prospects according to Kotak Securities. Second, we have is Angel Broking on CCL products. Now they have initiated coverage on the stock with a buy rating and a target price of 360. Now CCL product is largest Indian manufacturer and exporter of instant coffee with around 24% market share. Also, the company's hedge business model has created a healthy moat for the company. Also, the company is ramping up its existing facilities to foray into newer market, which is a positive when it comes to CCL products. The Vietnam expansion is an excellent strategic move according to the brokerage. Now, the Vietnam plan could be further expanded to export to countries like China, USA, according to Angel Broking. Now, the company's robust business model has created free cash flow, which keeps its balance sheet strong and return ratios healthy, according to Angel Broking. Going forward, the Indian retail business will be another booster in the near term. Lastly, CCL is expected to maintain its 17% plus growth trajectory over FY18 to FY20, backed by its capacity expansion and enter into new geographies.
Thanks, Somit. Now, here are a few stories that you should consider reading on the website bloombergquint.com. First up, Desi cuisine and yoga will mark the start of the 5-day annual jamboree of the rich and powerful from across the world in snow-laden Swiss ski resort town of Davos later this month. India will be in the spotlight with Prime Minister Narendra Modi expected to be present for the first time. Second, temperature across the globe spanned more than 85 degrees Celsius at the weekend as Sydney was scorched and parts of the US froze. Western Sydney touched a 47.3 degrees Celsius on Sunday afternoon, the city's hottest day since 1939. Weekend temperatures at Mount Washington Observatory in New Hampshire plummeted to minus 37 degrees Celsius. Well, that's all we have time for on this edition of Daybreak, but all you need to know is up next. Do stay tuned. This is Bloomberg Quint.